How much are you willing to lose? Imagine spending years building your investment portfolio, only to lose it all in one bad trade. That's not just a nightmare. It's a reality for those who ignore one key rule: risk management. In this video, we'll show you how the smartest investors and traders use stop-loss orders and precision risk control to protect their capital and stay in the game, especially when markets get volatile. Subscribe now so you never miss essential strategies that build wealth without blind risk. Why risk management is non-negotiable. Risk management is the foundation of all successful trading and investing. Without it, even the most promising strategy will fail eventually. Capital preservation ensures you stay in the game long enough to benefit from your wins. Behavioral finance research shows we feel losses more deeply than equivalent gains. This is known as loss aversion. The majority of traders lose money not because they pick bad trades, but because they don't limit losses or manage position sizes correctly. Defining stop-loss orders. A stop-loss order is a predetermined point at which you exit a losing trade to avoid further loss. There are several types. Fixed percentage sets a flat loss threshold, e.g., 2% of portfolio. Trailing stop moves up with the asset price, protecting gains. Volatility-based uses indicators like ATR, average true range, to calculate a dynamic stop distance. Automation ensures discipline. Your emotions can't override logic mid-trade. But beware, poorly placed stops can get triggered too easily in volatile markets. Position sizing matters. Position sizing determines how much capital you put into each trade. A golden rule: never risk more than 1 to 2% of your account per trade. To calculate position size equals account size times percent risk divided by stop loss in dollars. This approach helps you survive a series of losing trades. Adjust your size based on the trade's stop distance, which should reflect the market's volatility. Determining your risk tolerance. Risk tolerance is a mix of psychology and financial capacity. Ask, how much loss can you absorb without panic? What's your time horizon? Do you prefer fast-paced or slow-moving strategies? Assessing this honestly will help you stick to your plan. Emotional traders are more likely to override stops or overtrade, both of which are fatal. Risk-reward ratio, simplified risk-reward ratio, R to R, measures the potential gain versus potential loss. A 2-to-1 ratio means risking $1 to make $2. Higher ratios help compensate for losing trades. The key is to identify high-probability setups with favorable ratios and stick to them consistently. Even a strategy with only 50% win rate can be profitable with the right R to R. Trailing stops and break-even strategies. Trailing stops are dynamic stop losses that follow the asset as it moves in your favor. They lock in profits without you manually adjusting. Once price moves significantly, some traders move their stop-loss to the break-even point, ensuring a no-loss outcome if price reverses. It's a great way to manage trades in volatile conditions. Using volatility for risk control. Volatility affects how far a price can move in a given time. Using indicators like ATR, traders can set stop-losses that adapt to market conditions. For example, low ATR equals tight, stop less room to move. High ATR equals wider, stop to avoid being stopped out prematurely. This helps you avoid getting stopped out on normal price fluctuations. Risk management for long-term investors. Risk management isn't just for day traders. Long-term investors also face downturns. They manage risk by diversifying assets across sectors and geographies, using stop losses or mental exits to preserve capital hedging positions with options like puts or collars. Even rebalancing your portfolio periodically is a form of risk control. Tools and platforms for automating risk. Modern trading platforms let you automate stop-loss, trailing stops, and take profit levels. Tools like MetaTrader, TradingView, Think or Swim, and broker-native apps offer built-in features. Combine with journaling apps like Edgewonk to analyze how you manage risk over time. Learning from historical losses. Study famous blow-ups, long-term capital management, Archegos, or even retail traders during the 2020 COVID crash. These events show how poor risk management can unravel billions. Conversely, legendary traders like Paul Tudor Jones and Stanley Druckenmiller survived by protecting capital first. Creating your risk management plan. A strong plan includes max percent risk per trade, R to R minimums, maximum daily weekly loss caps. What to do after a streak of losses. Write your rules down. Review weekly. Make tweaks only with reason, not emotion. The psychology of risk management. Your worst enemy is your own mind. Fear leads to premature exits. Greed leads to ignoring stops. Ego resists admitting a bad trade. But with a disciplined risk plan, you free yourself from these traps. You're not trading for today. You're trading for tomorrow, next year, and the next decade. Subscribe now and turn on notifications to level up your investing confidence and keep your capital safe. Don't just trade. Protect. Plan. Prosper.